Sandip Sabharwal joining us in the studio from AskSandipSabharwal.com. Sandip, great having you as always. Let me first have your take with regard to InterGlobe, the entire saga that's playing out. You believe that this monopoly, duopoly of sorts can continue despite everything that's playing out? You've seen enough cycles, you've seen enough companies, you've seen enough regulators act on things like this. Give us a sense of your take.
See, airlines is a very difficult business.
Correct.
I think it's one of the most difficult businesses, and secondly, it's B2C. So, in a B2C business, it's very difficult for someone to actually establish a business also which could have some regulatory favors or in a manner where some norms can be tweaked, etc. Because it's the confidence or comfort of the consumers in a sense. So, and we've seen so many airlines in India fail. So, starting from, I don't know where it started, but I think in recent memory, Sahara, Deccan, Go Air, so many of them, and Kingfisher, of course. So, whoever wants to get into airlines, they need to decide that they have to put in at least 5-10,000 crores initially, make losses, and then maybe establish themselves. So, I don't see any major airline additions or new players coming in the near term.
So therefore, good time to maybe nibble on to IndiGo because you're now trading at sub 40 times. It's a 1.8 lakh crore in terms of market cap, did maybe 8,000 crore in terms of PAT in FY24. So not looking particularly expensive, plus this monopoly kind of business. Good time to nibble on to?
I think it's a good time, and as a disclosure, like we also bought yesterday also.
Okay.
And I think these are good levels to buy in InterGlobe, because see, people were not getting an opportunity because the stock was not correcting at all while the broader market was correcting. So bad news in good companies is typically a good time to buy. In my view, in 1 week's time, no one will be talking of InterGlobe in terms of at least the controversies, and everyone will be traveling on InterGlobe.
Yeah, and they already have that 10,000 rupee voucher where they have to redeem. So yeah, that's going to push people back, I guess, to InterGlobe and make them realize that all is well once again. But that said, Sandip, I doubt Keynes would be a story that you're touching.
No, I would not, because everything is in. So you need to make a differentiation. Here, some operational collapse happened, but there is no corporate governance issue. Like Keynes, some corporate governance issues have been raised. Plus, most of the valuation is on some future businesses, where I think even the semicon and all plays people are very excited in. But you go and look into the history of even established players in semiconductors, it's very difficult to stabilize those plants and bring about productivity in a manner where you pull out, because it's a very high operating leverage game. So, how many of them will actually be profitable in that, we have to see. And the valuations, like last year they reported 45 rupee earning, if I remember rightly. So, on that it's still at some 90 times earnings. And now with all these disclosures, whether the kind of earnings growth that they were reporting will continue, or so things are very unclear. So, my guess is that people should wait out for some time, see how when the results come out, more management interactions happen, how things play out, because a lot of these stocks are too retail owned now, and institutional holding is very limited among very few funds. So that also reflects that institutional investors are not exactly confident on the future of these stocks or the credibility. So my guess is wait it out.
Is there anywhere within the EMS play that you're invested?
No, because of these very things where the margins on the current business at least of companies tend to be just 2.5-3%. One client going away, one such controversy can lead to sudden profit declines, and we've seen that some high-flying stocks in this segment suddenly started reporting negative results. So, and on those valuations, stocks are still at, I would think most of them still trade at between 60 200 times earnings. So I don't know how we justify those.
The one which will be in focus is ICICI. The one which will be in focus is ICICI AMC, the IPO, and it's one of the most anticipated IPOs, largely also because of the size, and it's opening today, more than 10,600 crore in terms of the issue size, and it comes with more than 3 decades of the company handling money for Indian households. Marquee names, players, they've already participated in the anchor book, Temasek, Fidelity, JP Morgan and more. Shesha joins all of the details with regard to that IPO.
Well, yes, it's a big IPO, Harsh. 10,600 crores. That's the amount that ICICI AMC is looking to raise via IPO. It will open for subscription today. Today will be the first day. It will be open till Tuesday, which is the 16th of December. Now, remember, the price band has been fixed at about 2,061 to 2,165 rupees per share, which values the company at about 40 times price to earnings. Now, this compared to other listed players, the likes of HDFC AMC, is at a mild discount. HDFC AMC currently trades at about 46 times. So valuation wise, it is either at par or at a mild discount as compared to its biggest peer, which is HDFC AMC. Now, if we look at the total amount of money that it currently manages as far as its AUM is concerned, quarterly AUM, average AUM for the quarter ended 30th of September stood at about 10.9 lakh crore rupees. That's the amount of money ICICI AMC actually manages. Now, since you also spoke about anchor investors, it has already raised quite a few amount of money from big anchor investors, the likes of GIC, which includes Temasek, and several FII investors, Fidelity, Norges Bank, BlackRock, we have Capital World, JP Morgan, White Oak, HSBC, AMC. So several funds have already invested money in this IPO via anchor book, which was opened yesterday. So yes, big IPO, all eyes will be on that as the company is looking to raise about 10,600 crores.
Right, okay, that's on ICICI Pru. Sandeep, of interest?
Yeah, ICICI Prudential is one of the best AMC plays actually, if you see, and a strong track record. Good part is out of the AUM of 10.8 lakh crores, which they said September ending, most of it is active management, so it's not passive funds, like, and to that extent the valuation should be given. The only question is what should be the right valuation. So the IPO valuation is around 1,10,000 crores. So assuming they end this year at 12 lakh crores of assets, so it's around 9% of AUM. So 9% of AUM is somewhat of a stretch for an asset management company. Typically, historically, we used to value these companies at around 6%. So, but in the current market scenario, many of these companies are getting valued a bit higher. So I would think it should be a long-term wealth generator, but in the near term, it might not do much.
Looking interesting to you? It's obviously a small company in that sense, large runway for growth, infra play in India, and prefabrication, which is likely going to be, or pre-engineered products as they call it, PEBs. Something that attracts your eye. Good blend of new age along with decent valuation.
I would agree with your comments, but unfortunately, I haven't studied this company, so I have no idea.
Sure. Okay. And then what within infra, Sandeep?
So on the infra side, what's happened is that last 1 year, we've seen most of the stocks correct significantly because of execution issues. So first it was the general elections, then delayed payment releases, then this year's monsoons were very severe. So all of them impacted many of the companies. Now we need to focus on the larger companies out there who have a track record and where execution will be strong next couple of years. So on the construction side, we own 2 companies, NCC and Ahluwalia Contracts. So I think both of them I'm still quite positive because I believe a lot of the negatives are in. Execution will pick up significantly over the next few quarters, and valuations are cheap relative to historical valuations.
What about the related or allied spaces, the likes of paints, cement, etc.?
So I think paints should do well. I believe the worst of the impact of Opus entry is now there. Now the entrenched, the earlier players will now also start growing, and Asian Paints in its recent interaction also has indicated that growth seems to be coming back. So I think that segment should do well. But on cement, I think we need to wait it out because prices are under pressure even in the peak construction season, and supply increases have been very rapid and demand has not kept up. So the good part for them is that costs have been under control, and that's what has driven their margins. But I think that lever is no longer going to be there going forward. So pricing needs to improve, and the seasonal improvement in prices has not happened this year. So there is an expectation it would start from next quarter. So let's see on that. But valuations are expensive in relation to historical valuation, although long-term growth prospects are good.
Okay. Cement on your radar at all on charts?
Nothing. I think most of the stocks are still going to a time-wise correction, so nothing major which is coming out in the charts.
Kunal, yesterday some of the capital market plays, like we were discussing, they made a comeback. Angel One, BSC, and we were drawing the correlation with PVR, right? The box office hits correlate with PVR moving up, and similarly the market moving up correlates with some of these cap market plays. But again, would you buy something for a sustained period?
Yeah, I think BSC is the only one which is more strong, sustainable. MCX is the other stock which has been doing phenomenally well. So these are the two pockets within the capital market space which looks attractive. Most of the other names, you look at Angel One, you look at CDSL, CAMS, etc. These stocks have been, I'll say, all over the place. But then at the end, when you look at the 3-month, 6-month performance, it's been more flattish for these stocks. So that heightened phase of volatility, if you participate in that, you get your short-term returns. But if not, then the returns on the medium term are a lot more flattish. But in terms of trends, BSC and MCX are the ones which have done very well. So if in case there is like a meaningful dip, we saw 30% dip on BSC from 3,000, I think at the start of this year, towards the point where the stock was 2,100. So those are strong, meaningful dips where one should look to participate on.
What about capital market plays for you, Sandip? You're finding any of those interesting, and how do you play that theme?
So I think most of the stocks Kunal mentioned, so I would agree with his assessment that BSC tends to be the more credible play. MCX has done well, but very correlated to gold, silver, etc. also. So if many of these commodities stagnate or correct next year, then we need to see how it will perform. And brokerages I typically don't like so much because they are more transaction based businesses, and there's too much volatility in the earnings.
And Sandeep, what do you make of the realty theme? There was recently a project launched in Vikhroli by one of the listed companies, which got 81% or interest, virtually 81% of the bookings already done. The stocks haven't moved much, but traction within realty continues. And there are various theories to this. Now we've seen 1 year the markets have gone nowhere. Typically when markets go up, you see real estate do well. But now markets have also not gone anywhere. And yet real estate in a pricey Mumbai micro market is doing well. So your take, a good time to nibble into?
So realty project launches are like IPOs. No one looks at the valuation. So I think that I don't think we should go too much by the project launches.
Sure.
The fact of the matter is realty prices moved up all over the country. Then they stagnated, and then they have corrected somewhat in many of the regions. Like NCR and all, people have talked of correction, and many other markets there is a correction. But in a reducing interest rate environment, typically realty stocks longer term will do well. And this time in the realty upcycle, the participation of investors is not so much, which used to be there earlier. So the speculative built-up was not there. So I would think that it was a big up move. There's now been a decent correction. There will be some consolidation, and then some of the credible players will again move up. So I think offhand, I would say that not exactly talking of valuation, but companies like DLF, Godrej Properties, etc. I think they will give opportunities.
Kunal, you also prefer those charts, right? DLF Godrej?
Yeah, DLF Godrej are the ones which are more stronger. Prestige also, I think, is the other stock which has done reasonably well on a pure, relative price scale. So maybe that could be other favored name. But then you have to time these stocks very well, because if you time it at the wrong cycle, you're not just looking at the price depreciation or a price correction, but the waiting cycle is more elongated. And for a point when the markets are extremely volatile, there is always a fear, or maybe some sort of an anticipation that the real estate stocks could fall much more sharper because of their high beta. So that, I believe, could be the only aspect which one has to look out for. You have to time stocks at the time when the stocks go into a turnaround mode, rather than anticipating a turnaround for these real estate names.
Tata Steel, that's the other one which is going to be in focus, could be set for another major capex over the next few years, according to the company's growth plan stated in their latest con call. Ashesha joins in with the highlights of that call which happened yesterday. Ashesha.
Capex announcement that came in from Tata Steel day before yesterday, where they said that they are looking to add capacity in India to the tune of 10 million tons per annum by FY30. Now remember, Tata Steel's global capacity currently stands at 35 MTPA, out of which India capacity stands at about 25 MTPA, which they are now looking to increase by about 10 million tons per annum as a result of the capex plans that they announced day before yesterday. The company, of course, in the con call yesterday did not specify the quantum of capex or the impact on debt on account of increase in capex. These details were not given in the con call, and the management said that perhaps these details will be given by the end of the year once the capex is put into place. But we have some brokerage houses which have come up with their reports on the estimate of capex that is likely to be incurred by Tata Steel. Nuvama, first of all, says that they estimate growth capex to the tune of 95,000 crores to 1 lakh over a period of next 6 years, which is by FY30. They believe the expansion will be internally funded and net debt is not likely to rise on account of this. So that is one important estimate which Nuvama has given after the Tata Steel con call yesterday. Citi, meanwhile, says that they believe exact capex timelines and contours will depend on clearances, demand and profitability, and how these three factors shape up going forward. So they have not given any estimate, but they believe that it is likely to be decided in the due course of time. Centrum, meanwhile, says that leverage trends amid rising capex will be the key monitorable, but Neelachal Ispat expansion and potential greenfield opportunity under the MOU that they have signed with Lloyds Metals will be the key driver of growth for Tata Steel in the long term. So yes, Tata Steel management has not given any capex or debt guidance, especially because of the rising capex, but brokerage houses believe that it could be anywhere between 90,000 crore to 1 lakh crore over the next 6 years.
Okay, that's that on Tata Steel. Kunal, let's get a chart check on silver, because that will also then correlate with Hindustan Zinc.
I'm very bullish on silver, even at current levels. So yes, the run up. So this is more of a correlation which was there between gold and silver. So this is more of a statistical rally in terms of gold versus silver, which is happening right now. Mid of April somewhere, there was a point where silver came into a 3 sigma standard deviation at an extreme with respect to gold. That time gold prices were around $3,200, $300, and was $30 to $33. Now gold prices are at $4,200, $4,300, and silver is almost at 60 plus. So it's more of a statistical correlation. We've come back to the mean for the silver prices, which means now I think at current levels we should stagnate for the silver prices, at least in terms of dollar terms. So that major part of the euphoria or the rally now seems to have baked in. Because of that statistical, maybe say a correlation, deviation of such sorts, now I think we should stagnate over here for some more time. But this move, what has happened in the last 6 months for silver prices, this will have an effect in going into 2026, and we should see more upside there.
But who will win, gold or silver? Or do you think now, after this stagnation, both the prices will be sort of head to head?
See, what happens is when there is an extreme amount of correlation, markets don't come into neutral and then stabilize. They go into the other extreme, and then comes a phase of stability. So we went from a 3 standard deviation negative to maybe a possible 1 standard deviation on the higher side. So silver has to outperform going into the first half of 2026. And then we may see that silver will probably come back to normalizing.
Sandeep, your view, gold, silver?
So I think, so a lot of people are talking of silver shortage right now, and that there's going to be shortage going forward. But I think news follows the price. So like Kunal was saying, 6-7 months back, no one wanted to buy silver also, and now everyone wants to buy silver. And a lot of ETF flows are happening, so those people are buying it, so that's also creating some sort of shortages. So I would think that I never like to buy things in a parabolic up move. So I think silver is in a parabolic up move. At some stage it will have a severe correction. At that time we can look to buy. Longer term trends of both these commodities should be good, given that the debasement of the fiat currency which is happening and the way monetary policy is playing out globally. So longer term trends will still be positive, but given the move of the last 2-3 years in both these commodities, I would think that there will be a phase where maybe for even 4 to 6 quarters these commodities might go nowhere, correct somewhat, and after that they give opportunities. So right now if you have them, just keep them, but I don't suggest buying them right now.
And Sandeep, what about the larger metals basket? For example, Tata Steel doing capex. It's a good cycle currently to be doing capex in. Are you anticipating the next 1 to 2 years to be good with regard to metals, or do you believe that there could be some downside risks coming in, especially from China?
See, metals, there are various plays. So copper, aluminum plays could continue to do well. Steel is not really a story because steel still has huge overcapacity globally. Yes. Steel prices are going nowhere, and this kind of capex then creates a situation where anyway you are not generating any free cash flow, so you keep on investing more and more. So I typically avoid such commodity plays.
Okay, that's an avoid in commodity at least. But Honasa Consumer, that's going to be one stock to look out for. They've now entered the men's grooming segment with the latest acquisition of a brand called Regional Men. They've initially acquired a 95% stake in BTM Ventures, and the remaining 5% is going to be acquired after 12 months. Snehi is here with more details about this latest acquisition by Honasa.
Well, yes, so Honasa Consumer has forayed into the men's personal care space with the acquisition of BTM Ventures, which is the parent of Regional Men. This provides category, channel and geographical expansion opportunities for Honasa. And also remember that the Indian's men's personal care market is projected to reach 40,000 crore rupee plus by 2032. So it's a good space to foray into right now for Honasa Consumer. This is also going to help Honasa strengthen its market share in the south, because remember, majority of the revenues that Regional Men derives is from the south, so that is important to watch out for. A little bit about Regional Men. It was founded in August 2022 by Trisha Reddy Talsani, and they make products like sunscreen, serum, hair serum, moisturizer, face cleansers and face washes for men. And if you take a look at the revenue trend of the parent company, 2023 to 24, very modest revenue of just 43,000 rupees, which saw a sharp uptick of 20.15 crores in the year following that. And from October 24 to October 25 this year, they've netted a revenue of 74 crores with an EBITDA of 18 crores and EBITDA margin around 24%, indicating good health of the acquired company. The terms of the transaction, Honasa will now acquire a 95% stake at an enterprise value of 195%, with the remaining 5% to be acquired in the next 12 months at a pre-agreed valuation. If you take a look at the valuation of this deal right now, on an annualized April to August revenue run rate, this values the deal at an implied EV to revenue at 2.6 times and EV to EBITDA at 10.9 times. It looks like a positive deal for Honasa Consumer as well. This also adds to Honasa's deals of D2C acquisition in the recent past. Remember, they acquired B Blunt from Godrej Consumer in 2022, acquired a majority stake in Dr. Sheth's in 2022 as well, and they've also acquired 25% stake in Fang Oral Care very recently, and now they've forayed into the men's personal care space with this acquisition. So Honasa Consumer is going to be a stock to watch out for today.
Right. Okay, that's that on Honasa Consumer. The BPC segment, of course, looking mighty excited. Kunal, just a chart check on Nykaa, because it seems that that massive phase of selling is done. The stock has, of course, lifted off from those 52-week highs, but where next?
Yeah, I think it's in a good trend for itself. The last 4 quarters, the stock has managed to repair itself in terms of the price trends. So that first, say, a hard work in terms of the prices, that's done. Now I think the stocks are just stagnating or going to of a consolidation on this 250, 270 odd mark broadly for the stock price. I believe for the next at least a quarter or so, the stock should try and stagnate into this trading range, fluctuate around this 10% odd kind of a band. But then I think if it maintains this level broadly of 250 mark for itself in the next 3 odd months, then I believe that the next trend on the upside could re-begin for Nykaa. So bullish on the stock from a medium-term perspective, not so much on the short-term aspect.
Okay. Some of these other new age counters, Sandeep, a delivery, a Swiggy Eternal, of course, but a Paytm, for example. Where do you see them at this juncture now? We've seen some bit of stability on some of these names. In fact, delivery doing well. There's been some bit of outperformance there as well. The results have been better. The e-com express business has picked up. Your sense?
So I've been studying delivery closely over the last few quarters. So there's been incremental improvement, but I think that's come at the cost of them slowing down a bit, because controlling costs, slowing down a bit, etc. So how much operating leverage they can bring about cutting costs to improve profitability is something we have to see. So the stock has had a strong run up. I think it went to 300 odd. From there it's run up to 420 odd.
Yes.
So I think at this price, the valuations seem a bit stretched.
Okay.
So again, you were talking about Nykaa. So Nykaa also, I think this year it's done exceptionally well. Incrementally, there is continued improvement. And I think that's one stock I would say should be on the, we should be tracking to buy on some dips or whenever there are opportunities.
Interesting. Okay, that's that on delivery as well as Nykaa. But Sandeep, is this the market where you hurry to buy, barring of course individual cases and levels that you're tracking?
Not really, because nothing is going to run up very rapidly. So I think you can take your own time, accumulate stocks whenever you get opportunities. This is not a market which is going to suddenly run up. It doesn't seem so now. At some stage next year it could. So next maybe couple of months could give opportunities for slower accumulation.
When you say next year, you mean fag end of this fiscal? Or
Financial-
latter part of the
I always
calendar
talk
year?
calendar actually. So 26 could see better movement in most of the broader market stocks.
From now, do you think, Sandeep, the budget could play any role in lifting market sentiment?
Not really. The only thing they can do is, if they are inclined to, is to take the capital market related taxation back to the older levels, which I don't think they are inclined to. I don't think they ever would. They are not, because they don't see that as a priority in terms of the government. So if that happens, that will be a positive surprise. If otherwise, I think budget won't make so much of a difference.
Cable and wire stocks, Sandeep, I know your constructive paints. Would that also be an interesting play, or valuations not giving you enough comfort there?
Yeah, cable and wires again, very commodity kind of businesses, and plus again Ultratech has announced a huge foray into cable and wireless. So I believe next year they'll come in. That creates some competitive issues in that segment, like what happened in paints.
Yes.
But the impact in paints was much more because there were fewer players. Cable and wires is more diversified. The impact could be lesser, but valuations, you are right, are stretched.
Okay. All right. Sandeep, we'll let you go. Thank you so much for joining us this morning and giving us those perspectives.